Good morning, good afternoon, or good evening, wherever you are in the world, and welcome to this CoinDesk live webinar on the Asia-European arbitrage opportunities for crypto derivatives. My name is Nick Lord, and I am the moderator of today's session. One of the key market trends that have emerged in 2021 has been that traders are now trading in multiple markets to find more arbitrage opportunities. This is especially true looking at crypto derivatives, arbitrage opportunities between Asia and Europe. So to discuss this fascinating topic, we are joined by two highly distinguished speakers, and it's a great pleasure to welcome them. Firstly, we have Sam Sandiford, who is a senior derivative structurer at BitMEX, which is part of the 100X group in Hong Kong, where he's worked for the last 2.5 years. Sam has extensive experience of building out derivative product delivery across multiple client segments and geographies. For 13 years, he worked at Standard Chartered Bank in a variety of roles, including FX options and rate structuring, and covering specific client groups and different geographies as well. Welcome, Sam. Gabriel Bassas, who's the VP of EMEA and APAC at Velecom, was one of the earliest players in the low latency network and data solutions space for capital markets. Gabriel has delivered numerous projects across EMEA and APAC for traditional derivative traders, banks, market makers, and native crypto trading firms. Gabriel has extensive knowledge of fintech firms' challenges and their requirements to stay competitive by identifying the next niche in this heavily accelerating and competitive crypto markets environment. Gabriel, welcome. So I think we're very well placed. We have people from the markets and then from the networks. We can really dive into this topic across a number of different areas. Before we do, though, I'd just quickly like to get both the speakers to introduce themselves and tell us more about what their firms do in the crypto trading space. Sam, perhaps you could start.
Thank you, Nick, and good morning, good afternoon, good evening, everyone. So BitMEX is one of the largest cryptocurrency derivatives platforms globally. It's been running for about 6 or 7 years. I've been with the firm for 2.5 years, and I run the structuring team, which means that I put together all the contracts on the platform, how they pay off, how they're priced in terms of fees, the margining and liquidation methodologies as well. And on top of that, I look at expanding our product suite as we go forward, be that contracts themselves or into different types of margining and other services.
Great, thank you. Gabriel.
Yes, and I've been with Velecom for around 5 years now. Velecom own and operate a proprietary trading network, fiber optic network that connects financial exchanges across markets in America, Europe, Asia. We've over the last 10 years, spent a lot of time working with market makers, proprietary trading firms, latency sensitive clients to fine tune and build and develop our fiber optic network to serve asset classes in the FX space, equity, commodities, and now growing into the crypto space. So yeah, a good standard in terms of delivering connectivity, co-location, market data, managed services for a number of years now. And I predominantly work in the EMEA and APAC market. Yeah.
Great. Well, both of you, thank you very much indeed for your time and for the insights that I know you're going to be able to give our audience today. Let's kick off with looking at market structure, if we can. So the current crypto market structure it's changed a bit in recent years, especially in order to support more institutional participants. Sam, perhaps you can kick things off by discussing the evolution of the crypto markets.
Sure, I think partly by design and partly by chance, the markets have definitely evolved to be more institution friendly over the last couple of years. I think there are 3 areas where this is really the case. First of all, in terms of efficiency, both of operation, capital and cost. Secondly, in terms of security, compliance and trust. And thirdly, in terms of the market opportunities that are available. And if I start with those first, this kind of presents itself in terms of volume, venues and contracts available to trade. So I'll give you a few figures. We'll look at the spot market quickly. So the spot market at the beginning of 2019, January, it traded about $0.3 trillion. That has grown through 2019 to 2020 to 0.9 trillion, and now it was about $1.7 trillion in July of this year. The derivatives market 2 years ago was more like $50 billion at the beginning of January 2019. Now it trades 2.5 trillion. So the derivatives market has grown over and above the spot market in the course of 2 years. And I see that as a trend that will continue. Even though spot markets continue to grow, there continue to be more contracts to trade. In the spot markets, the derivatives are taking over as more and more institutional players who are comfortable with derivatives are taking part in the markets. If we move on to the number of venues, back in 2019, there were probably 2 or 3 serious derivatives venues. There were some trading futures, but the key product in the crypto space back then and still now is the perpetual swap. And there were only 2 players then. Right now, we have 9 or 10 very serious players. So there's far more opportunity to trade between venues for customers. And thirdly, the number of contracts available to trade. Back in 2019, there were 1 or 2 perpetual swaps. There are now 3 exchanges that have over 100 perpetual swap contracts listed. BitMEX itself has 25. So there's many more markets that are available to traders to take advantage of and to run their strategies on. If we move to security and compliance and trust, there's been a move in the space to make exchanges more regulator friendly in terms of customer verification, and there's been a few announcements in the market of that this week from one of our competitors. Also anti-money laundering and actually submitting to standard regulation. While crypto derivatives is not regulated fully in any part of the world yet, many regulators are moving towards that, and BitMEX and other companies are in discussions to try and make that a reality. Thirdly, in terms of efficiency of capital, fees have come down. Margining has become cheaper in terms of the maintenance margin, initial margin required to put trades on, and also the systems of socialized losses that companies had in the past are no longer really coming into effect. So the last auto deleverage on the BitMEX platform was in 2019. The last big deleverage in the market was probably in 2018. So institutions who were unhappy with that socialized loss methodology are now unlikely to be subjected to it, partly because all these exchanges have built up large insurance funds to protect against these things. So those 3 things are probably the things that have changed the most over the last 2 years.
I mean, that's an extraordinary rate of growth, isn't it? From a and certainly during a period of time where markets have been, let's say, traditional markets have been through their own upheavals. Do you think the 2 are linked?
I think part of the printing of dollars has driven some people to crypto, but I think it's also bringing on the retail space people who wouldn't traditionally have invested in markets at all. It's a new generation of investors there. I think in the retail space, the institutions are growing, but probably from a more solid background as well.
Okay. We're going to dive much more deeply into volumes a bit later on in the discussion. But Gabriel, perhaps I can bring you in here to discuss about this market transformation from retail to institutional, and also the trend that prop shop firms are using arbitrage strategies to trade on more market than they were on average.
Yeah, absolutely. I mean, I like the question, how has the crypto market structure changed to support institutional participants? And I kind of like to flip it on its head a little bit. We know the narrative about compliance. Most exchanges are now enforcing AML, KYC regulations. We know that large investors, putting billions into this asset class. Exchanges like Coinbase are now going public. We've got institutions like Grayscale offering services to institutions. The energy efficiency debate is kind of coming to a good conclusion. The miners in China, the FUD around that is now kind of settling. And obviously there's now proof of stake asset classes that are resolving this issue. So I see now it changing a little bit. I see it more how are institutional participants changing how they support the crypto market. And you see that in traditional exchanges. You see Australia Stock Exchange, ASX, building out a completely new settlement system using distributed ledger technology, using VMware blockchains, which interestingly will require all members to become nodes of the blockchain. So it'll be interesting to see how that develops. 2023 is when I expect it to go live. I think they can go live now, but I don't think members are ready to build the required infrastructure. And that's going to be phenomenal. It's going to bring in around $3 trillion worth of securities when you think that the market is about 2.1 million right now in crypto. So you're seeing a big drive from the traditional space. Let's flip it a little bit on the crypto exchanges. I'm seeing a lot. Something new, actually. I work a lot with the sell side. I work a lot with market makers, investment banks, who are all trying to optimize their networks to provide services for investors, hedge funds. Now I'm actually seeing a bit of a change. Now it's not that difficult for hedge funds, high net investors to use in-house specialists to build and manage their own smart order routing capabilities and access hundreds of new asset classes on the crypto sphere, incorporating multiple geographies, including 10 to 15 different exchanges. So we're seeing hedge funds now really doing the work of the sell side. But that's not to say the sell side aren't also getting involved. We're seeing a lot in terms of market makers and proprietary trading firms changing the way that they build and operate their networks. I mean, there's a very niche, subtle difference between how traditional exchanges, how you would trade on those and how you would trade on crypto markets. So we're seeing the change from these organizations, and there's a big wave. I still think that there's room, time, space for the investment banks to come on board, but they're certainly having the conversations right now. And I see 2023, 2024 being a big year for this. If I was to knock on the door a year ago and talk about crypto, I would probably be made to feel a bit shamed, and I'd have to put my head down and say, hey, you're interested in crypto. But now you say the word crypto and you're welcomed in, and they actually want to hear more about value and what other people are doing in this space. So it's a huge shift in how institutions are now seeing this as a brand new opportunity to invest. So it's interesting.
And when you have those conversations with the banks, and you talked about the subtle differences, and you mentioned the Australian example where all participants need to become a node in the blockchain, obviously crypto market structure is not going to develop in exactly the same way that traditional markets, because of the underlying differences between the products. What sort of key things should, let's say, international investment banks be made aware of about market structure when they're thinking about setting up this business?
I mean, they've really got to be open to new ways of creating and building infrastructure. If you look at how traditionally infrastructure is made, you will have a bank, or institution, they will co-locate in a data center where the exchange are based. They will buy physical hardware, expensive hardware. They will purchase all the required connectivity to connect to all the different traditional exchanges. So it's very deterministic. They know exactly what the latency is going to be. They know exactly all the variables. There's no unknown variables in the traditional scape. Whereas with crypto exchanges, they're based in cloud environments. And from a customer's VM to the cloud, to the exchange in the cloud, there is undeterministic variables.
Right.
And so maybe that's something that institutions that are a little bit unfamiliar with, and they don't really maybe like this so much. But it's either for the crypto exchange to change how they build their infrastructure, or for the institution to adapt and accept the way the crypto exchange has built out their infrastructure. And I think it's the latter.
So, I mean, there are market access challenges and issues around connectivity. Perhaps, again, Gabriel, you can talk about the issues that have arisen around these these factors. And really that there is this strong appetite for expansion to connect more exchanges to trade crypto derivatives. How does this manifest itself in terms of the cost of entry to trade? And how do you basically use low latency links to try and outperform competitors?
Yeah. So, I see that there used to be a massive wall, a barrier of entry for traders to be able to trade in trading infrastructure. You have to spend a lot of money and invest a lot of time and have a lot of specialities in terms of building infrastructure. But now, say for example, you want to trade spot markets between BitMEX in Dublin and FTX in Tokyo. You can simply open an account very easily in the matter of a day. You can then get a relationship with a cloud partner. AWS probably in this scenario would be best. You would set up a VM in the matter of a day. You would put your compute, your trading strategies, you would load them up on the VM, and quite simply get a direct connect to the exchange, or use a WebSocket access to access the exchange. So in terms of barrier to entry is completely removed. You can access and build trading infrastructure in a matter of 3 days at the max. And so now that you've built this infrastructure, I'm talking about 2 different exchanges. Now the next challenge is, how do you perform arbitrage between the exchanges? So you're in your AWS environment, and your means of outbound connectivity are three options. You've got the internet, which is ideal for new entrants. It's very low cost, but in terms of deterministic latency, it's not very good. In terms of jitter, also not good. It's slow. So we're seeing a lot of customers move to the cloud's proprietary network. But then this is easy, simple, and what most customers would use, because most customers aren't aware of other options. But if you look at cloud operators, they're not focused on the finance vertical. They've built hundreds and hundreds of gigs of capacity to connect all their different geographical regions. But the finance sector is just one of the verticals that they serve, and it isn't the most important vertical. So now option 3 is using an ultra low latency proprietary network, and in this case using a Velocomm. Velocomm being the fastest optical network to connect all these exchanges. So you're leveraging a network that has been used for the last 10 years, used by HFT, proprietary trading firms, investment banks. It's now accessible in AWS. So you've essentially got a low latency network. And how do we do this? We are a partner of AWS. We're a partner of Alibaba. And so what we do, we've essentially installed BGP nodes in all the exchanges, and that allows for any-to-any network configuration. We offer customers dedicated port access in all the exchanges. And so you put presence in BitMEX, you put presence in Tokyo for FTX, you put presence in Hong Kong, you put presence in Chicago, in Ashburn, Virginia. Before you know it, you've built out a smart order routing network at very low cost and at very low time. So essentially, you've got a cloud network using a proprietary network. So I think that's one of the avenues that a lot of customers that speak to us are very interested about.
Great. So now this is available, as you say, to that you can build your own proprietary network around the world, and then you're looking at trading, and this is where we come I suppose, to the underlying markets and the arbitrage opportunities that exist between Asia and Europe. Different levels of liquidity in the Asian and European markets are making, I suppose, these arbitrage opportunities increasingly attractive. Sam, perhaps you can talk about how this manifests itself between different markets and different time zones.
Sure. So I think the traditional view of having geographically separated markets that have closing times, opening times, and don't fully overlap is somewhat redundant in the crypto space. It's really important to remember that this is a 24/7 marketplace. But 24/7 doesn't mean that the liquidity is even every day and every single hour. So there are improved pockets of liquidity at different time zones. Somewhat like the FX markets of old, we tend to find that the derivatives markets are most active when both Asia and Europe are in, because of some of the locations of the derivatives markets and their Asia focus. Actually, during the US time zone, the derivatives markets are a little bit more quiet, but spot-wise, we tend to see a fair amount of action still between Europe and the US time zone. So what that really means in terms of opportunities is if you're looking for differences in markets, there's more going on and you can find more during that time zone crossover between Asia and Europe, and location-wise as well. We think most companies don't like to give away exactly where they're locating their servers and their matching engines, but as a rule of thumb, full service exchanges doing spot and derivatives tend to be based out of Asia. The pure derivatives exchanges right now tend to be based out of Europe, and then the pure spot exchanges are a mix of Europe and the US. And that location difference, I think, is where low latency networks like Velecom can actually provide a difference to customers to actually take advantage and be able to make arbitrages between those markets.
And with those actual arbitrages, just to sort of carry on with this, how quickly are price differences eradicated? Are there the same products being traded at different prices at the same time just because they're in different markets and there are different liquidity levels there? Or does the, I suppose, the capability of low latency networks mean that these price differences are gone in an instant?
I think it's getting towards the latter. There are a number of high frequency trading firms that have been operating in the crypto space for some time, but often using their own infrastructure. There is a fight to be the fastest. There's a slight kink in how this works because none of these contracts are truly fungible. So there are slight edge risks. Nothing's a perfect arbitrage across exchanges. But I think there is still room to be faster, and that speed and low latency can still give an edge in these markets. I think that what's helping that as well is that matching engines and exchanges are getting faster and getting better at keeping up.
And so is there any trend towards standardization of contracts? And to that extent, you writing the contracts?
So I don't think there is at the moment. I think for each exchange having their own proprietary contract is beneficial. At some point, maybe a consolidated market will come together. But I think I think Gabriel talked about 2022, 2023 for banks coming to the space. I think we're looking further down the line for that if we're going to get a standardization across crypto exchanges.
Kind of crypto ISDA might emerge. Gabriel, you've got some really interesting data that I think you want to share with our viewers, looking at how liquidity levels are somehow different across the world at different times of the day. Perhaps you can show us this, and I think this is your own data from your own system, so I'm fascinated to see this.
Absolutely, there is. We have a pretty unique perspective on the market, being a telecommunications company, systems integrator. We've put together a bit of information as to which exchanges are the most popular. Can you see the screen?
Yes.
Can you see the slide? Okay. So what we have here is essentially, on the right-hand side, a list of the exchange locations that we see the most popularity in. And so obviously BitMEX being the most popular, and AWS Tokyo and being a very close second. What we see about Binance and Huobi FTX, you're getting a lot of concentration of exchanges in one location. Similar to LD4 Deribit, you're getting, LD4 London, you're getting Deribit, LMAX, Bitfinex. So you're getting a concentration of exchanges in single locations, which means that customers can get sort of like more bang for their buck by co-locating in these venues. And obviously, we're now seeing Singapore for Bybit becoming a lot more popular, Bitstamp, Coinbase, Kraken. And so what customers are doing, they are getting port access with a Velecom in all these locations that provide them with smart order routing capabilities from any network to any network. And one of the values to a Velecom is that we have we built the quickest network between Europe and Asia. There are multiple paths that we use, but they're all owned infrastructure that routes from Europe through to Russia into Tokyo. We've also got routes that go through Kazakhstan into Hong Kong, and we've optimized services into Singapore. So how this looks like, maybe slide onto this. You see a huge saving in terms of latency. Currently, traditional firms, they'll be happy for a 1 millisecond, 2 millisecond latency advantage would be, they'll spend millions for that kind of advantage. And now we're in a position where we can offer up to 77 milliseconds of latency advantage between London and Tokyo. Close to 60 milliseconds between Dublin and Hong Kong. These are significant latency advantages that we provide. And so it becomes quite a popular conversation to have with customers when we present them with these latencies. And by the way, this is comparing the Velecom network to the AWS network. So the AWS network would be what most trading firms would use without being aware that there are other proprietary networks that can be used. But when you set up AWS, which is quite easy, you would just share your AWS ID number with a Velecom, and we will send you a connection request in your AWS portal. You would accept the connection, and in the space of 24 hours, you're now using the Velecom network instead of the AWS network. And so the reason we're seeing Dublin and Europe and Asia a lot is because of the latency advantages that are offered between these markets. And that's a testament, like I said, to AWS not optimizing their networks. They have other objectives in mind. They have, connectivity isn't AWS's main bread and butter. It's co-location, it's virtual computing. And so they are, from a connectivity perspective, they just want to get low cost, high bandwidth. And so they will take subsea cable systems that take all sorts of bizarre and indirect routes to get from A to B. Whereas Velecom, we've spent the last 10 years, battling the FX market, commodities market, the equities market in terms of, really trying to battle off any other competitors to provide our customers with the lowest latency networks. And now, because the exchanges, the crypto exchanges, are based in the same exchanges, the same data centers as traditional exchanges, it's so easy to for them to migrate into these kind of cloud environments. So
it's amazing. It just sort of reinforces the centuries-old Silk routes, doesn't it? The way between Europe and Asia. Whoever has that advantage goes back to Marco Polo. And it's the reason why Hong Kong and Singapore are where they are, and London, Dublin again. This is fascinating. We're getting a load of questions in from the audience, but I'm going to carry on going through because I think quite a lot of these questions, I was just looking at them, are going to be answered in what we have to say. But we'll get onto it. So Sam, in terms of crypto products. New crypto products are derivative products are emerging all the time, and some are more correlated with existing products than other. I mean, can you explain really what you see as being the ones that are the most popular and the ones that offer the best trading opportunities? And we're talking crypto derivative products here.
Sure. I think in terms of the natural place to go in the crypto space right now in derivatives, it's still perpetual swaps. It's still perpetual swaps between platforms. There's highest volume, there's most interest, there's institutions and retail in the same space. That's where the action is right now. I do see the space growing up a little bit. The futures curves in various platforms are evolving. They're becoming more liquid. People are starting to trade curve plays as well. But the real big next step, which hasn't really properly happened yet, is the options market. Deribit obviously are there, CME are there, a few other platforms have started, but we haven't seen that take off yet in the way that the derivatives market did in the numbers that I mentioned at the beginning of the show. So I think...
Why do you think that is?
I think there's one key thing here is leverage. The leverage that's available in the market, up to 100 plus times leverage, means that in many cases where someone would buy an option for a cheap long-term view on something, they can just buy the underlying. They can take that view straight away with the leverage. So from a retail perspective, it's not that attractive yet. What the market needs is it needs a supply of vol from the retail side for market makers to then recycle and use for other things. I think that will come through the exchange space, but I think it's going to take a little bit longer. It's going to need more institutions involved, and I think that it's coming, but I think it's probably next year or the year after where we see that acceleration, like we did in the linear space 2 years ago and last year.
Okay. A question from the audience. What popular instruments are most arbitraged between Asia and Europe?
It's probably the Bitcoin perpetual swap. It just has the deepest market. People like we have a number of clients who trade on multiple platforms, and they are trading like multiple times a minute because there's opportunities all the time for them.
Okay, and another question following up from that, how about arbitrage opportunities inside exchanges with no need for high-speed networking? Is that a possibility?
There's not pure arbitrage opportunities, but between contracts, you can effectively trade the triangle in certain places. There's not many exchanges that offer that because you kind of have to have a spot and then two futures. But I think that will develop over time, and certainly when options markets get going, there will be mispriced or inaccurate price inefficiencies that will get swallowed up by market makers that do that in the equity space already.
Yeah. Okay. So they'll probably largely keep whatever difference there is.
Yeah.
That's their spread. Yeah. Okay. So I mean, you talked about vol and how a common concern is that crypto markets are too volatile, but for derivatives, obviously, volatility is the lifeblood of derivatives. When volatility picks up, what are the best practices for price discovery and trading? This is a concern for institutions that when the market gets very volatile, prices disappear. The understanding is that it's got better, but perhaps Gabriel, you can sort of tell us about your experience in this, both from a personal and an institutional point of view.
Yeah, I mean, from a personal perspective, let's say, for example, Bitcoin is currently at 47,000. If Bitcoin starts moving to 51, 52, 53, it starts to become very difficult to access your Binance account, very difficult to open your Coinbase account. Volatility is around how many users are accessing the exchange. And in terms of in situations like that, it becomes very difficult to close out any orders or take advantage of the price changes. This is more from a retail perspective, and I asked Sam this earlier whether or not there were different methods for institutional investors to avoid these pit holes when prices swing from one way to another, and to be able to get in. I definitely know from a retail perspective, the infrastructure isn't there to take advantage, and many people can be liquidated because of not being able to access the services of the exchange.
And so, but is that situation improving for institutions?
I mean, I think the difference between institutions and retail is that institutions will have WebSocket access directly into the exchange. They'll use APIs, and so they'll use more refined technology. They'll be using Velecom-like networks, so they'll be able to take advantage of that speed. They'll have direct access from their virtual computers and the exchange. So they're in a completely different game from retail to institutions, and the institutions are the one that are winning this game, and retail are the liquidity.
Okay, Sam, perhaps you can talk about price discovery in periods of volatility, and how you see it from an exchange point of view.
Sure, and I think there's kind of three areas that can be an issue when vol picks up, and Gabriel touched on the first one, which is how do I get an order into the exchange when it's busy. That's something that's really improving across the marketplace. BitMEX and other exchanges were criticised in the past for overloads. Orders would get rejected because there was just too much order flow coming through. The pipes are getting wider. The engines that are doing the matching, the processing are getting faster, and gradually that's improving. Again, touching on what Gabriel said, some of our institutional clients will use a mixture of WebSocket and direct REST API connections, just to get information coming out as quickly as possible and keep getting information in as quickly as possible. But the progress that's been made is fairly significant, and it is worth pointing out that crypto exchanges are not like traditional exchanges who have a handful, maybe 50 members into the exchange, and that's kind of the way in. There are tens or hundreds of thousands of traders plugged into any retail crypto exchange at any one time. So, and it's also 24/7. So progress is definitely being made. Once the order is in the book, the next problem is there anyone making a market? So a lot of traders, when connectivity issues arise, when people can't get their orders in, they will switch off. They will switch off for 5 seconds or 30 seconds, as long as they've got a flat position, and just try and reconnect. We found that more and more people are using direct APIs, including on the retail side. So 50% of our retail customers trade through API rather than the mobile or web interfaces at the moment. So there's more retail flow that's ready and that's there, and it's not having to click a button on the screen effectively. Bringing me back to my trading days of 15 years ago, where I'd kind of hit the Bloomberg terminal just to buy some euro-dollar futures. So retail sophistication is really helping as well. The third thing is around whether the orders in the book are actually real. So there's a lot of exchanges where that has been a problem in the past. So are people manipulating the market? Are people spoofing? Are people doing what would be called out as traditional market manipulation in normal markets? I think at BitMEX and across other exchanges, there's now much better market surveillance, and along with user verification, that's being taken off the table as well. So all in all, in a high vol environment, we expect much better performance now.
And obviously, vol is largely driven by spot prices, and given the huge explosion that you mentioned right at the beginning in derivative volumes, that usually means that there's better two-way flow in times of volatility. Derivatives require both sides of the trade to actually happen. Do you think that's a useful leading indicator to suggest that in times of volatility, now that there are much more derivative contracts out there, that there will be better two-way pricing?
I think it will be improved. I think there's still the volatility tends to pick up when there's a big sell-off and stops get triggered and the market collapses. I think Bitcoin trends up and it crashes down in general, and that's probably true of Ethereum as well. So there is more there now, and we are working with market makers to try and ensure that there is more, and exchanges as a whole, I think, are trying to employ market makers to be there in those situations. But it's very difficult to monitor and enforce. If something's dropping from 50,000 through to 40,000, most people on a trading desk will try and get out of the way as quickly as possible. The incentive to market make in that situation is probably not enough in most cases. So we have deep conversations with our market makers to try and get there. But but we don't really know. So when that happens, and we're kind of stuck with a position to liquidate at the same time, and that's where our insurance fund comes in, should we have to liquidate.
Okay, fantastic. Let's briefly, sorry, another question has just come through. What institutions are you seeing having the biggest order flow at this point? I suppose that's questions about institutional type. I don't think we want to name names, but
I think the space is still dominated by high frequency trading. There's not real money there. That's buy and hold for now, at least in most of the contracts that we look at. So high frequency is making up a significant chunk of volumes.
Okay. Margin complexities arising from margin currencies. How do you allow your customers to really manage the forex and crypto / fiat cross currency risks when it comes to posting margin? Because these can move in quadruple ways, always against you if you're not.
Yeah. So this is the problem across the crypto space. We're margining in different currencies. BitMEX margins exclusively in Bitcoin. FTX uses a dollar-like version, and so on. And then other exchanges will use Tether and/or coin margining. So unfortunately, right now, it is for the customers to manage that risk. I think there are examples of trades where there is no risk. There are examples of trades where it's easier for an institutional client to put on the trade where the margining makes less sense. So if we take a simple carry trade, where you take your dollars, buy Bitcoin, short a future, hold it to maturity, buy your dollars back. When that margining is in Bitcoin, it's a very clean trade. You lock in your futures basis, and as long as your slippage on the way in and way out is not particularly large, you basically keep most of the yield. If you were to margin that in dollar terms, go shorter a future that's dollar margined, as your futures price goes up, and with spot price goes up, futures price will definitely go up with it, then suddenly you're required to add more and more margin to the trade. So if I'm a retail customer, I'm not going to do that. It's too complicated. So I'll put my cash and carry trade on where I can margin coin. If I am an institutional customer, I can probably use the Bitcoin that I have for a collateralized loan to then get the dollars I need to margin my other position on a dollar-based exchange. So there are increasingly collateralized and cross-currency lending facilities starting to appear in the market, both within exchanges themselves and also by third-party providers. And that sort of complexity, I think, will be interesting for institutions as we go forward. Okay,
fantastic. One possible arbitrage opportunity we didn't really cover, and you spoke a little bit about the US being mainly for spot. Are there any arbitrage opportunities between Asia especially, and the US, or even Europe and the US?
Yeah, I particularly see Asia and the US being Tokyo and California, San Jose. So that's Kraken. And then I'd see Tokyo and Ashburn. They tend to be the popular routes for arbitrage. That would also include OKAX. So you'd see OKAX to San Jose, OKAX to Ashburn. Those would be the common two. Hong Kong and Tokyo to San Jose and Ashburn. Okay,
great. Well, we are coming up towards the end. This is absolutely flown by, and I've rarely seen as many questions coming in during one of these sessions that than we've had today. So this obviously, really generated a huge amount of interest. I do want to apologize to some of the people who have posted questions. I hope we've answered them. I've been monitoring as they come in. If I haven't, I'm sorry. Some of the questions have been specific to the institutions represented here, and I don't think this is the right forum for those questions. But if you contact us at CoinDesk, we will endeavor to get your questions and connect you to our two speakers. So thank you all very much for this. I suppose just to wrap up, what has really struck me during the course of this conversation is how intertwined everything is, from the size of the crypto derivative market to the underlying spot, to how important the pipes are that connect everybody together, to the proliferation of exchanges. All of this is coming together in a very, very complicated, but very, very interconnected way. And during this process, that's where the arbitrage opportunities seem to be coming out. Would that be a fair summation of where we are right now and where these opportunities are and why and how they're coming about? Perhaps you can both sort of wrap up by giving us this brief overview of how it all fits together. Gabriel, perhaps you
yeah, absolutely. It's a very interesting time, and it reminds me of 2008 when proprietary trading firms really started getting involved and doing a similar kind of service, and then it became cost prohibitive, and then these organizations had to consolidate, and now you're left with about 10 popular HFT firms. Now I'm seeing something very similar. You're getting institutional investment firms of around, sometimes 3 to 5 people, geographically dispersed, and coming in and buying everything, buying access to all the networks. So it feels like that period of time in 2008 when the beginning of HFTs begun. So there is definitely a vision on what can be done in this space, and there's an appetite, and firms continue to get involved in this space, and it seems like there's enough to go around for multiple different customers. We're getting no complaints. There are a few tweaks that you can do. We mentioned some of the infrastructure that a Velo can provide. Let's say everyone's using a Velocom. So how do you then do one better? So there are a few tweaks that we can offer. I'd probably like to share that in direct conversations with customers. But there's always something that can be done to give an extra latency edge in this market. So yeah, and where does it go from here? What's interesting is that crypto exchanges are based in cloud environments like AWS. We've seen traditional exchanges moving into distributed ledger technology using blockchains. Interestingly, AWS provide native blockchain services. So we'll see whether or not AWS adapts itself into serving blockchains rather than traditional exchanges.
Great. Is there an irony here that it's getting more centralized?
Well, I think it's more distributed, actually. I think we're seeing the theme of distribution and a move away from centralization.
Yeah, good. Sam, perhaps you could wrap up with your thoughts on the current state of the market.
Yeah, I think we're still in a developing state. The connectivity is established from other markets, and I think people are starting to adopt what's already been used into the crypto space, and it's really starting to make an impact. I think the product still has, like the payoff, the financial products still have some development to go for particularly adoption of options. I think options is really the big next stage that comes further down the track, and I think we'll see probably multiple variations before the one that sticks in the linear space. It was the perpetual swap that really accelerated the growth. I think we might see something in terms of payoff that is different again. It's not going to be exactly the same as the traditional markets, but we're looking around, we're experimenting to try and find out what works, and then maybe that's something that will get adopted back into the traditional space later on. Okay.
Well, both of you, thank you very much indeed for this fascinating discussion. As I say, I think this has generated huge interest. And I want to apologize if there were any connection issues during this. We are in a high latency environment, doing this via the internet, via things. It's not as swift and perfect as a proprietary trading network that I could mention. But I just want to say once again, thank you very much indeed. I hope everybody has got from this the ideas that will help them in their own trading strategies and their own thinking about how to set up a trading business around this. If you do have any further questions, please do get in touch with us at CoinDesk, and we'll direct you towards either Sam or Gabriel and make that introduction for you. So it just leaves me to say thank you very much. I hope to see you all at the next live webinar hosted by CoinDesk. And from me, it's goodbye.